Hi there, Craig Bosse, and today's video is about interest rates um, and how it's affected by different factors that go into a loan. So a lot of times people will see an interest rate advertised online, and they assume that that's just the mortgage rate. So everybody gets the same mortgage rate, but that couldn't be farther from the truth. So there's a lot of things that play into it. Number one, the biggest thing is going to be your credit. So, have you had a foreclosure, a short sale, a bankruptcy, something like that? Um, those sort of things, you may have to go into what's called a portfolio loan. Typically, those are going to be higher rates than your conventional loans. Um, there are other things that can cause it to have to go into a portfolio loan as well. I won't go into that because this video would probably be about 4 years long. So, Um, I guess number two thing would be the property use. So if it's an investment property, those rates are a lot higher than a primary secondary home. Primary secondary home is usually the same, although it just depends on the investor whether you come like a conforming limit or a jumbo. It could be slightly different, but they're usually pretty close. Investment property is going to be a lot higher. That's just seen as a higher risk. One other thing is the property type. Condos are always higher in rate. Um, Townhomes and single family homes are usually the same. There again, it could change a little bit depending on the investor. Um, Credit scores, that's going to affect it. I guess that's part of the part that's part of what I talked about earlier with credit history, but this would affect any loan. So usually there's some adjustment to the loan interest rate depending on where your credit score is at. Down payment, that's going to affect your interest rate. Depending on the program, it can affect a lot. Now, FHA loan doesn't really affect the interest rate at all. How much you put on down payment, and that's simply because it's guaranteed by the federal government. Other programs, it does because there's a higher risk to the investor on the back end. Loan amount. Loan amount's going to affect the interest rate, specifically when you change from the conforming loan limit, which is the same limit across the U.S., except for high balance areas will have a conventional loan, which is bought by Fannie Mae or Freddie Mac on the secondary market, and those in certain high cost areas will have what's called a high balance, and that's going to be generally a higher rate than your conforming loan limit. Then you get into jumbo above that, and a lot of times those end up being lower rate if they're a loan that you can qualify for. So the best rates on those are very tough to qualify for. So there's a lot of factors in it. I think I've covered the basics there, and I'd love to hear from you.